Hi, and welcome to this week's market presentation. Price evolution. Looking at the latest price evolution, we note an uptick in both oil, natural gas, and electricity prices in Europe over the past week. The gains, as before, more concentrated in the short term, with the front month in particular seeing the largest increases over the past week. Latest news. Looking at the latest energy news, hostilities between the US and Iran have erupted, with the interim memorandum of understanding deal collapsing following continued attacks by Iran against commercial shipping through the Strait of Hormuz, most noticeably attacking a Qatari LNG tanker, has resulted in renewed military action against Iranian military targets in the region. Additionally, the US has revoked these sanctions waiver on Iranian oil, and in return, Iran has declared the Strait of Hormuz closed for transit once again. This comes just as balances were beginning to normalize and tentatively sending Q4 supply and demand balances to a surplus. The outlook now remains conditional on the resumption of flows through the strait, although recent comments by both the Iranian and US governments point towards a potential further escalation in the conflict, and in the meantime, a halt to transit through the strait. The increase in the geopolitical risk premium rapidly repriced into oil and LNG markets. Brent crude surged by around 6% on the week, briefly touching $80 per barrel once again. Natural gas prices in both Asia and Europe increased as well, with TTF gas prices up over 15% amid fears of a prolonged LNG supply disruption. Global equity markets fell and bond yields rose on the renewed inflation fears, with the prospect of rising crude oil, refined products, and natural gas prices. Over in Europe, the European Union ETS reform proposal is due this week. The European Commission is considering rates as low as 3% for the annual reduction in the ETS emissions cap for the next decade. It is being reported that the proposal may also give up to 400 million allowances from its plant investment booster scheme from 2027, potentially weighing on those forward prices. The scheme's intention is to, quote, pay companies with allowances according to their progress in delivering emissions reductions. Sentiment at the moment appears bearish, particularly for the December 26 product, as it remains below the important resistance level of 80 euros per ton. Expectations of increased allowance supply and potential softening during the legislative process also putting some downward pressure on prices. Until we see the text of the proposal from the European Commission set to be released on July 17th, compliance buyers remain cautious amidst the ongoing policy uncertainty. Weather. Looking at the latest weather forecast, we know that the highly above average temperatures, particularly in France, are set to dissipate slightly through the middle of this week. However, temperatures are expected to remain above seasonal averages over the course of the next 7 to 10 days. Precipitation is going to be concentrated along Central Europe, with limited rain across much of Western Europe over the next 7 to 10 days. The Nordics, again, seeing more limited precipitation throughout most of this week, with an expected uptick in precipitation starting at the beginning of next week. Wind speeds are expected to remain relatively flat over the next 4 to 6 days before starting to pick up once again at the beginning of the following week. Crude oil and LPG. Crude oil prices reacted bullishly to the ongoing developments in the Middle East. Brent prices have seen the largest increases, with the front month up 5.4% on the week as of the 10th of July. West Texas crude up slightly less at just around 3.7%. Nonetheless, if we continue to see the halt to transit through the Strait of Hormuz, we're likely to start to see crude oil prices move further up, especially as global inventories are seeing lower levels following the withdrawals seen over the previous couple of months. The latest EIA monthly forecast for supply and demand indicates a continued supply deficit in the third quarter of 2026. Nonetheless, their latest forecast is still expecting for flows to normalize by the end of the third quarter, and by the fourth quarter, we're once again expected to see a crude oil surplus in terms of supply. Again, very contingent on a normalization of flows through the Strait of Hormuz, which remains to be seen. U.S. crude oil stocks continue their downward trajectory as the tightness in crude oil markets continues to result in withdrawals from both commercial and the Strategic Petroleum Reserve inventories in the U.S. The SPR is now falling to the lowest levels since the early 1980s. And if we do see continued withdrawals, there are concerns amongst analysts that once stocks go below 200 million barrels in the SPR, and certainly below 150 million barrels in the SPR, the structural stability of the inventories and this salt cavern storage could come into question, raising more concerns over future oil prices unless we see a return to transit through the Strait of Hormuz. Natural gas. Moving towards natural gas, where as mentioned earlier, prices rebounded over the past week. Looking at the TTF price evolution, we note the uptick, again, more concentrated in the short term, with prices for the front month and especially for the front quarter rising nearly 8% on the week, erasing much of the losses we saw over the previous few weeks. For the front year, prices are up 6.5% on the week, and once again higher than they were a month ago, before we saw the decreases as a result of the pause in hostilities between the US and Iran. Storage levels continue to add bullish pressure on the market, especially as we see the comparison versus the previous year with an increasing deficit, as injections into storage continue to fall below the average since 2012 and below last year's injection rate. Looking at total supply and demand, we note the decrease in total demand as temperatures moderated in Europe following that excessive heat wave over the previous 2 weeks ago, but at the same time, total supply also decreasing over the past week. Looking at total supply, we see a slight decrease in Norwegian gas flows, although they do remain at the top of the past 5-year range. On the other hand, LNG sendouts saw a sharp decrease again over the past week and a half, falling sharply below the past 5-year average. Concerns regarding LNG imports have certainly increased over the past week, as concerns over a prolonged pause in LNG exports out of the Middle East are impacting the market. Adding to the woes to LNG markets, the U.S. LNG terminal in Freeport has decreased operations due to some ongoing maintenance, reducing overall LNG exports. TTF investment fund positions are stabilizing with a slight increase in long positions over the past week as markets begin to reassess what a prolonged pause in LNG exports out of the Middle East could mean for European gas prices. Coal. Moving towards coal markets, coal prices increased for the API2 index for the front year, up nearly 5% on the week. The higher temperatures and resultant higher demand for fossil fuel power generation is increasing coal-fired power burn, as a result, increasing demand for coal. Adding to the concerns for coal power generation and coal demand in Europe, the lower water river levels at the Rhine are increasing logistical challenges in bringing coal inland. On the other hand, area coal stocks remain at elevated levels, reducing some of the bullish pressure on the market. Nonetheless, the increase in natural gas prices is increasing the competitiveness of coal-fired power generation, adding to demand expectations for the coming weeks. EU and UK emission allowances. Moving towards carbon allowances, carbon prices saw relatively steady price evolution, slight decrease on the European side of things, especially for December 26 product, largely driven by the potential bearish impact that the ETS reform proposals could have on the market. On the UK side of things, relatively stable over the past week, but the potential expansion of carbon allowances to include the maritime sector adding to future demand expectations. European power sector emissions noticeably lower than they were during the peak of the heat wave a couple of weeks ago, but are nonetheless once again on the rise as we see above average temperatures, increasing cooling demand across Europe, while at the same time ongoing power curtailments across the French nuclear power fleet due to cooling requirements is increasing fossil fuel power generation, increasing overall power sector emissions. Investment fund positions have softened slightly on the European side of things, again on some optimism regarding the ETS reform proposals set to be released by the European Commission on July 17th. While on the UK side of things, investment fund positions remain at record high levels. Electricity. Moving next to electricity markets, the German power market saw an uptick in prices for the coming month, extending through the last quarter of the year, up nearly 5%, the front year moving up little over 3% on the week. The increase in natural gas prices being the main driver of the uptick in electricity prices by increasing generation costs. The price evolution across other European markets was quite similar, with increases over the past week across the board and in the Nordics as well. European total grid demand remained relatively steady over the past week, nonetheless at the top of the range over the past 5 years on the back of the higher temperatures increasing cooling demand in Europe, but also due to year-over-year demand growth. If we look on the supply side of things, non-dispatchable demand eased off slightly week over week, but nonetheless remains at a record high level for this time of year. At the same time, when we do see those dips in non-dispatchable demand, it does lead to an increase in dispatchable output. If we look at non-dispatchable supply closer, we do see that decrease in wind power generation, which was in part compensated by once again the record levels of solar power generation over the past week. Lastly, hydro run over the river generation at 5-year lows. Looking at residual load, we see that uptick in fossil fuel power generation over the past week, again coinciding with the slight decrease in non-dispatchable supply. On the nuclear side of things, even though we do note the power curtailments across the French nuclear power fleet totaling 9.2 gigawatts this past Sunday, overall nuclear power output does remain in line with the past 5-year average in what is a positive development. Lastly, hydro reservoir generation at a 5-year low as well, particularly when we look at hydro storage levels at lower levels, especially in the Nordics. And lastly, looking at guarantees of origin, we know an uptick in the price level across most years and most production technologies. Overall, when we look at hydro prices, those remain facing the bullish pressure from the persistent Nordic hydro deficits. On the other hand, we are seeing record levels of solar power generation from Spain and France, easing some of the supply concerns. That covers this week's market presentation. Thank you for joining.